investments to lift Europe's productive capacity and speed up the green transition. Many other reforms will be needed to boost lackluster productivity. Priorities, of course, vary across countries. What is clear is it will take resolute, broad, and carefully crafted actions for European policymakers to address the triple challenges they face and simultaneously defeat inflation, sustain the recovery, and safeguard financial stability. Thank you.
Thanks, Alfred. We can now go to your questions in the room. I think we're going to start with Paula from EFE.
Hi, thank you. I would like to ask a question about Spain. This year is one of the countries that is growing the most in Europe, but for the next year, the forecasts have dropped significantly. Could you explain why? And I would like to have a comment also, a more general comment. With a growth of 0.88 in the Eurozone and the biggest countries like Germany really struggling, is Europe really far from recession?
Mm-hmm. So let me first start with the general European question. First of all, we should recognize that coming out of the pandemic, Europe had a very strong exit. And that was clearly a reflection of the strong policy response during the pandemic. And we see that in very high growth numbers in 2022. And as you know, we have upgraded them over time. What we are seeing now in 2023 is really the effects of the Russian invasion of Ukraine. That provided a huge shock to the European economies in terms of increasing and pushing up energy prices and inflation, which required more monetary tightening, lowered the purchasing power of people, increased the cost of production. And we are seeing these effects carried out in 2023. And that's, again, across all of Europe. We see differences in countries depending on how much they depended on the energy price, the energy from Russia, and how much they were affected by the energy prices. That explains some of the variation. But I should also say, again, when it comes to policymakers, they stepped up after the Russian invasion of Ukraine with packages which were addressing the problem. And the biggest problem we saw last year was a big concern that a Russian gas shutoff could bring the European economy to a halt in the winter. It did not happen, and that would have been a big recession in Europe. And it did not happen because policymakers increased supply, worked on reducing demand, and I should say, for once there was luck because we also had a mild winter. So that was really avoiding the big recession. And what we're seeing in 2023 now is the effects of all of this, but we also see during the year recovery taking place, and that is going to manifest itself more in 2024. Now, with regard to Spain, in terms of our forecast, Spain's growth, as you said, in 2022 was very strong, and we upgraded that. The outcome was 0.3 percentage points higher than we had expected. And that momentum is going to carry over into 2023. And therefore, we upgraded our forecast for 2023 by 0.4 percentage points. We have a downgrade for 2024 of 0.4, and that explains the delayed response to the monetary tightening and also to tighter financial conditions coming from some of the banking episodes we have. But overall, I should stress that taken together, 23 and 24 in Spain, of what we see cancel itself rather out. So Spain is in a rather good position, I would say.
Thanks, Alfred. We're going to go with the second row, gentleman with the gray shirt.
Of course. Good morning. Thank you for doing this. I'm Gianluca Di Francesco from Il Sole 24 Ore, Italy. I was wondering if you could elaborate a bit more on the advisability of ratifying the ESM that looks like a message to Italy. Thank you.
Mm-hmm. Yeah. So the ESM treaty, amended treaty ratification is part of the European Union's agenda of completing the banking union. And what it would provide is a backstop to the single resolution fund. And I think that's an important architectural element in terms of completing that element of the banking union. And it will benefit all countries involved. Other elements which are currently for discussion is to find agreement on a common deposit insurance, and also to find least cost resolution options for smaller banks. So that is a package of three. The ESM treaty completion or amendment is one of them. All three are important to complete the banking union. And then why is it important to complete the banking union? Because these measures are important to improve financial stability across the union. They will also allow for households and corporates to have more access to bank credit across, and hopefully over time also at similar costs, and therefore are going to benefit growth. And they will also make it easier in terms of monetary policy making in the European Union, and this, particularly by the ECB, because they will improve monetary transmission in the Union. I should add other elements of the Union should also be completed, and one of them is the CMU, which we have been advocating as well. And again, that will help in terms of deepen capital markets, and it will help in terms of medium-term growth and increasing productivity.
Thanks. We're going to go with Phil, first row, Bloomberg.
Thanks. Yeah, Phil Aldrich at Bloomberg. Thanks for doing this. I just wanted to know a little about the UK. After the disastrous mini-budget last year, has the UK rebuilt its reputation here? What's the impression of the delegation this week? So how has the reaction to them been? And on Europe, on the deposit insurance, there's been discussions in general about raising the level of deposit insurance, possibly. Is that something that the Europeans should consider as well, given the financial stability concerns?
Mm-hmm. So thank you. On your first question, the answer is unequivocally yes. When you're looking at market reaction to the autumn statement and the spring statement, we see now that gilt rates, mortgage rates have reversed their increases. And you will also see that the pound is stronger than it was pre-mini-budget crisis. And so the answer to your question is yes. What we see in the spring statement again is an acknowledgement of, or an alignment with medium-term fiscal sustainability, an alignment with the broader objective of achieving the inflation target. And those are excellent elements which we have been indicating are needed for the UK. And when we are looking at other elements of the spring statement in terms of improving labor force participation, and also in terms of providing incentives for business investments, those elements are very important, and they should set also the stage for future policy making. Because what we need in the UK, as we need in all across Europe, we need to boost productivity. We need to step up reforms to ensure medium-term growth. And we need to undertake a huge transformation as part of the green transition that we are envisaging. So more is needed, and I would say that this is not just applying to the UK, but across Europe, on focusing on the labor force, upskilling labor, improving training with active labor market policies. But also then, when you're looking at the green transition for the European Union, they estimated that the green transition will require investments of 4 trillion euros. 3/4 of that needs to come from the private sector. And that means we need a massive amount of private sector investment, and the private sector needs to be part of that as well. With regard to the deposit insurance, at this stage, we have advocated a common deposit insurance across Europe, so that is our recommendation. And of course, policymakers need to look at the lessons learned from market turbulences, and all of the elements of reform which are in the pipeline need to be assessed in light of that, and see what we are learning from these episodes, including on deposit insurance.
Wienen?
Thank you for doing this. Wienen von Petersdorf, Frankfurter Allgemeine Zeitung, German newspaper. Why is Germany performing so poorly, and is there more to it than only energy prices, dependency on energy price? We don't see substantial growth since 5 years almost in Germany, and is Germany the new patient of the European Union?
No, it is not. When you're looking at the growth pattern in Germany, it is very similar to other European countries. Again, Germany had a strong exit from the pandemic. It experienced weaker growth than we expected in the fourth quarter of 2022. And Germany is one of the countries most affected by the economic effects of the Russian invasion of Ukraine, because of its dependence on Russian energy. And that played out already in the fourth quarter. And when we are looking at our forecast for 2023, that slowdown and that momentum of the slowdown has carried over into 23, and that's why we see the downgrade with regard to Germany. I should also say that we are positively surprised about the resilience of economic activity in the first quarter. And when you're looking at our forecast, you will see that throughout the year, we are actually forecasting an increase in GDP of 0.2%. And then, of course, in 2024, we will be in positive territory again. So the German economy has been affected more than other European economies. The policy response was strong and appropriate. We are expecting growth to resume during the year. But it's, of course, going to be challenging. And challenging will be something which applies to Germany as well as to many of the European countries. We will need to step up over time public investment, which has been lacking over the last few decades. And that public investment is needed for the energy transition, for maintaining and building up infrastructure. And that is going to be an important part of any policy going forward, because that's going to ensure productivity and medium-term growth, and that applies to Germany as well.
Thanks, Alfred. We're going to go with Jorge, first row. Microphone. Please, first row. Thank you.
Thank you very much. Jorge Valero with Bloomberg as well. Sorry about that. A question on the comment you made that some governments need to pursue more ambitious fiscal consolidation. So what governments do you have in mind when it comes to Europe? And also, in that context, the European Commission is going to propose in the coming days, coming weeks, a review of the fiscal rules. So do you think that this review should consider more adjusted fiscal paths for member states, or there should be like some common benchmarks like some countries are calling for?
Mm-hmm. So our call on the fiscal consolidation actually comes in two parts. The first one is with regard to is with regard to achieving the inflation objective. And we have been saying that fiscal policy across Europe needs to be aligned with the tightening of monetary policy. And that means for Europe also that across Europe, more consolidation right now would be better in terms of helping on the inflation front. So that's a recommendation to virtually all governments in Europe. And that would help actually allowing the ECB less of a rate hike. That would help then on having less of an impact on debt service, and that would help in containing financial stress, which is coming through interest hikes. So that's a recommendation to virtually all of the countries in Europe. The fiscal stance is neutral to mildly consolidating across, but again, if more could be done, that would help. And what is the more that can be done? There are some easy gains. Energy prices are low. That means some of these energy packages, cost of living packages, can be phased out. Second, in many countries, they're still untargeted, and that means to make them more targeted makes them more efficient, less costly, and put less pressure on aggregate demand. And what we also seen is that we have some windfall tax revenue gains because inflation is higher. Those savings should be saved, and that will also help on the fiscal stance. So that's number one. The second issue is with regard to medium-term consolidation. And I should say that with regard to medium-term consolidation, our advice for most of the countries is actually, again, to do more, but in particular to the high-debt countries in Europe. And here we're going back to the story we had already last year before the crisis, the war on Ukraine. We need fiscal consolidation in the medium term in Europe to create buffers so that when the next shock is hitting Europe, the fiscal policy can be used, governments can respond. And what we have seen in both crisis episodes with the pandemic and the Russian invasion of war, that response was essential in order to prevent a much worse counterfactual outcome. With regard to your question on the European fiscal framework, we very much agree with the proposal which was made by the Commission. This is a proposal which is based on a risk-based approach and a country-specific approach. It looks at the medium-term sustainability, and it moves to an expenditure-based rule. Those are recommendations we have been making, and we are happy to see that incorporated in the Commission's proposal. For us, it's important that there is a differentiated approach between countries because the situations are very different, and so they need different fiscal adjustment. That's very important within the current framework to emphasize. What we would have wished is, one, to have a counter-cyclical fiscal capacity in there. Again, that would provide macroeconomic stabilization during shock times, and that helps maintaining growth. And also to have a facility in there to help with public common goods, like a climate fund, which could operate across the European Union. Those are not proposals on our side which have been incorporated. And we would also have wished a strengthening of and a creation of a European fiscal forum in order to have that kind of agency fully empowered at the union level, which we see already at the national levels. Now, there are still discussions going on the fiscal rules. For us, it's important that these discussions are being brought to closure soon, so that these rules can be brought to fruition and can be implemented soon, and so that we don't have a prolonged period of a situation where we are staying with the existing rules, which we know are in need of being upgraded.
Thanks, Alfred. Alex Brummer.
Alex Brummer, the Daily Mail. The UK is in the latest forecasts is at the bottom of the advanced country and the G7 and the European Advanced Countries Growth League. I wonder why it's in that position. And there's a view in the UK that the IMF has consistently underestimated the growth possibilities of the UK. And I just wonder if you could answer that.
Mm-hmm. Yeah. First, again, what we see in the UK is a growth pattern over the last few years, which is very similar of what we're seeing in the rest of Europe. We had super high growth rates in 2021 and very strong growth in 2022 exiting from the pandemic. And we now see a sharp slowdown in 23 and a recovery in 24. So this growth pattern is the same across all of the countries in Europe and the same in the UK. Why do we see in the UK quite a sharp slowdown next year? One, and that is an issue which is to some extent I already addressed with Germany. The energy price shock is hitting the UK particularly hard because a large part of household budgets are spent on gas energy, and that therefore lowers purchasing power and real incomes. So that is an effect which is much more pronounced in the UK. Second, what we also see is that we have employment which is still below pre-pandemic levels, reflecting still continuing sickness and scarring from the pandemic. And of course, we also saw that the Bank of England was raising rates quickly and appropriately. And we are seeing the impact of a tighter monetary policy on overall demand. So that leads to a situation where the growth slowdown in the UK is larger than what we see in some of the neighboring countries. With regard to the growth forecasts, we are making a best effort to take all of the facts into account, checking our assumptions across and making the best effort in terms of our forecast. It's very difficult during the last 2 years to be very accurate with forecasts. First, with the pandemic, we had to assess how things would evolve on the epidemiological side and the virus. And now with regard to the shock brought by the war, it's very difficult sometimes to understand how price rises percolate through the economy and are affecting economic agents, and both shocks are overlaying. So when I'm looking at the forecast, I would not in general get too excited about point one here, point one there. We are in a situation where we are still working under a lot of uncertainty. And I should also say, usually we are being accused of being overestimating and too positive on growth. Again, we are making a best effort always to come up with an objective and accurate forecast for all countries.
Thanks, Alfred. The gentleman in the first row.
Hello, good morning. Igor Nemushin, RIA Novosti, a Russian news agency, Washington Bureau. So, questions about energy. In March, Shell CEO Vael Savan, he stated that China's zero COVID policy was a relief for Europe as it led to shift LNG flows from China to Europe. So the affordable LNG became a rescue for EU. As we're approaching next winter, do you see risks that Europe could face LNG deficit that can impact the economy? And the second part, it's also about energy related to oil and price cap on Russian oil and Russian oil refineries. What impact does it have to European economy now, and how can it impact European economy in future as relating to Paula Pina, Director of Directorate General Energy of European Commission? EU is still buying Russian energy, including 40% of Russian diesel. Thank you.
Mm-hmm. So with regard to your first question, Winter 23-24. There's still clearly some risks with regard to the energy security, but mostly on the pricing side of going through the next winter. But I would say the risks are much, much lower than we had before, because what happened in the winter 22-23, first because of the very strong policy response by European policymakers. Supply substituting for Russian gas delivery was up. The system was more integrated in Europe. Demand was reduced, and what we saw is quite a substantial increase quite a relative higher storage level of gas coming out of that winter. And with a higher storage level of gas coming out of that winter, that also puts less pressure on the market in order to replenish the reserves during the summer, which are then being used in the winter. Last year, clearly, LNG purchases were helped by the continuing lockdown in China at that point in time. And clearly this year there's a risk, if the rebound in China is larger than we expect, that this would put price pressures on refurbishing that storage. But we are not expecting the same kind of worries we had for the winter of 23-24 that we had for the winter of 22-23, because Europe is just in a much better situation of having diversified its gas production and also gas imports, but also in terms of having reduced demand. With regard to the Russian oil, most of the oil has been substituted through other imports, and we would not expect a serious disruption coming from that side for the European economies.
Thanks. Sorry, we are running out of time, so I'm going to take the question from our fellow from Ukraine. You had a question.
Dmitry Shvey, Interfax Ukraine News Agency. How would you assess the economic dependence between Russia and Europe today? How it has changed for past year, and what your outlook for this year? It's a new question about not only the oil and not only the gas, maybe finance, maybe agriculture, maybe other area. Thanks.
Mm-hmm. Yeah. With regard to dependence of Europe on Russia, that was mostly a dependence with regard to energy imports and mostly on the gas side. And gas imports or dependence on Russia has fallen quite significantly from 40% before the war to 10% now. So much less dependence on gas, and that is a reflection of alternative supplies and LNG in particular coming into Europe. And the same is applicable on the oil side, where Russian oil and oil products are being substituted through other import channels. With regard to your other question, that was referring to which economy?
Between Russia and Europe in other areas, not only gas, not only oil, maybe some others, maybe finance, maybe fertilizer.
Yeah. So in general, with regard to the financial linkages, they have been very limited, and they have been reduced further. So there is also less interconnectedness on that side. I think you're pointing to fertilizer and food and grain. And I think that's a particularly important point, and that is an important point for the globe. The discussion again is on the export of Ukrainian grain to continue now. This is an important point not only for Ukraine, but that is an important issue for global food security. And we certainly hope that an agreement can be found and these grain exports can continue.
Thanks, Alfred. I'm sorry, we run out of time, but let us know if you have follow-up questions. We'll try to get back to you. Thanks so much for joining the press conference. Thank you so much, Alfred, and have a good day all.
Thank you.